Good morning and welcome to the Killik market update. We've seen a bit more volatility in markets this week with a fairly strong start on Monday morning followed by some weakness later on in the week. On Sunday night we had the speech from Boris Johnson in which he outlined some plans to start reopening the UK economy. And initially the reaction to this seemed quite positive. On Monday morning we saw the FTSE 100 opening upwards quite strongly. However, throughout the trading day on Monday, it seemed to become quite apparent that a lot of people viewed the latest guidance as being quite unclear, and throughout the trading day we saw the market gradually turn negative. Then on Wednesday this week we had a speech from Jerome Powell, the chairman of the Federal Reserve, and markets across the world reacted quite negatively to this speech. And I think one of the reasons was that previously the Federal Reserve has perhaps suggested that markets could bounce back fairly quickly from the current coronavirus situation. However, in the latest speech, they seem to allude to a much longer recovery. Here's a quote from the speech. Jerome Powell said that, "Recall that the Fed has lending powers, not spending powers. A loan from a Fed facility can provide a bridge across temporary interruptions to liquidity, and those loans will help many borrowers to get through the current crisis. But the recovery may take some time to gather momentum, and the passage of time can turn liquidity problems into solvency problems. Additional fiscal support could be costly, but worth it if it helps avoid long-term economic damage and leaves us with a stronger recovery." So following the speech, we really did see quite a negative reaction in markets, and it's likely that the comment about a recovery taking a long time to gather momentum is the reason behind that. However, perhaps one positive to take away is that it does appear that the Federal Reserve does stand ready to deliver more stimulus if it deems that that will be necessary. We've been talking for quite some time about the struggles of property funds that have high levels of exposure to retail property, but with the current lockdown situation and the fact that so many people are now working from home, there has also been a huge challenge for the owners of office property, and this was quite apparent in the latest results from Land Securities, which came out this week. And Land Securities is one of the largest real estate investment trusts on the London Stock Exchange. Within the results this week, the company commented that their property valuations have dropped by 8.8% over the last 12 months, and a large proportion of that decline can be attributed to the coronavirus. They've also said, quite unsurprisingly, that all of their hotels and leisure facilities are closed. And finally, they said that at the moment, only 10% of their office capacity is currently in use. And at the moment, there really is a big question mark over what the future of the office will look like. So many people are currently working from home, and so many are finding it to be so successful that it seems unlikely that we will ever go back to the days when everyone would go to an office every single day. And I think the consensus at the moment is that in the future, all people will want to work much more flexibly. So this begs the question of whether demand for office space will ever get back to its former level. And perhaps this is why we saw such a big fall in the share price of Land Securities when their results came out this week. Here's a chart showing the share price over the last 5 years, and as you can see, it hasn't been particularly successful, largely because of the focus on retail property, but you can see there has been another significant decline this week following the publication of these results and perhaps the comments on office space in particular. And also on the subject of flexible working, we watched a really interesting interview with the chief executive of technology consultancy Accenture this week. And in the video, she commented that the performance of companies who have invested in technology is far ahead of those who haven't. And specifically, she said that the top 10% of technology investors have experienced revenue growth that's more than twice as much as the bottom 25% of technology investors. And those numbers were relevant before this lockdown started. And she has said that that gap has significantly widened now that the lockdown has begun. The reason being that the companies who have invested in technology are far much more nimble and much more able to adapt to this new situation. So perhaps with that in mind, it's not surprising that we've seen the share prices of these technology providers, for example Amazon and Microsoft, performing particularly well versus the rest of the market since this lockdown began. Moving on to the week ahead, looking fairly quiet in terms of companies reporting, but we're looking ahead to results from Chinese internet giant Alibaba and retail giant TJX. That's it from us. Enjoy the weekend, and we'll see you next Friday.